Good evening and welcome to another exciting edition of Bond Squad After Hours. Excuse me for playing the Eagles. We're going to talk about a little bit of life in the fast lane or a race to the bottom in the currency markets. But first, let's give our disclaimer. This broadcast, as always, is brought to you by Wealth Strategies and Management, WS&M LLC, and Bond Squad. WS&M LLC and Bond Squad are separate entities from PAG, Private Advisor Group, which is a registered investment advisor and our registered investment advisor. PAG makes our portfolio management business or SMA business possible. We thank them for all their support. And so let's get down to business. So things were running kind of as expected in the markets. Last week we saw a payrolls report. Wage growth was kind of weak. Employment cost index was weak before that. So it looks like, in our opinion, we're getting close to full employment, and this is the wage growth we might be seeing. There might not be an uptick in it, right? So last week and early this week, we saw that the 10-year Treasury note, the yield on the note, fall below 220, come back, and then surprise, surprise, on Tuesday, China announces that it is going to conveniently let its currency float a bit. And by this we mean that it's going to set the peg versus the prior day's close. So in other words, now that China's economy is weakening and the yuan or renminbi should drop in value, China's willing to let it float. When it was strengthening, China wanted to control that float. It really, without pressure from the U.S. and the ECB, it probably wouldn't have let it increase the value at all. But for whatever reason, China's doing it. The China apologists are saying it's because they want to become a free and open market and become a reserve currency. Probably want to become a reserve currency. But we believe the truth is, or at least the partial truth is, that China's economy is slowing more than anyone, including us, believed before. So China's economy, according to official data, which we take with many grains of salt, is growing about 7%. In our discussions with international fixed income strategists, the word out there is that it's probably below 6 already. Now we're hearing whispers, and this has been in the financial media and around the street, that maybe China is actually heading towards recession. Maybe there's a contraction coming up. And it wouldn't surprise us because China's gone from bubble to bubble and has tried to prevent them from deflating, or at least flip one bubble to another. Don't worry about your real estate, put your money into stocks, and we'll go from there. Meanwhile, internal demand is cracking. China might have grown all it can grow under this quasi-planned partial capitalist system. We don't know what to call it. It's communism, I guess, but it's a rather unique brand. So that might be all China can do. Now, China it has a problem. China has well over 1 billion people, and trying to please all of them is like herding cats. You have different cultures, different languages and dialects scattered across a large piece of Asia. It's not easy to manage the expectations, and that is what the Chinese people and consumers have come to expect. They expect good outcomes, positive outcomes from the government. So the government is incentivized to keep the people happy. You don't want over 1 billion people upset with you. So China's trying to keep everyone happy. So now the currency comes down. Now, we think that it wants to increase exports a bit. China exports to the U.S. have been coming down. Notice we have our racing gloves on, life in the fast lane. All right, but China's been trying to go to a more internal demand-based economy. Problem is, when exports drop, there are some cases that these businesses, not all of them very well run, have been going out of business. So they have to create jobs somehow. So maybe there's some truth that they're trying to liberalize the economy, and there's probably a lot of truth that China wants the yuan to become a reserve currency. but there's also much truth in the fact that they're trying to reclaim some market share by devaluing the currency. And what that's done, that's pushed down yields of the U.S. Treasuries, of the 10-year note in particular. That's our benchmark. So we actually hit 209 today before we rose back to 215. It really doesn't matter as far as the bond markets goes in the near term why China is devaluing its currency. The fact that it's devaluing puts downward pressure on inflation, especially in the U.S., because if their currency goes down, ours goes up, right? And one of the main tactics would be to take the yuan, can buy dollars, strengthen the dollar, weaken the yuan, and put it into treasuries. So now, what are the other export-driven economies going to do? Well, they might have to follow suit, and this is the problem. Trying to lower your currency is great when you're the only one doing it, but if you do it, everybody else does it. It's a race to the bottom, with no one gaining a clear advantage. So they end up exporting disinflation or deflation to the United States. We think that the strong dollar story is not over. It is in the early stages of that race. So we think the dollar can strengthen more. With that being said, what's China's economy? Well, China's demand is dropping. The imports fell 8.6% in July. Their exports fell 8.9%. The economy is really slowing down, and there are a lot of similarities between China now and Japan of the late 80s, where it was overextended. We see that happening here again. It's not necessarily a terrible thing for the U.S. We don't think it brings the U.S. into recession, but asset prices, commodity prices, interest rate expectations, inflation expectations, even equity prices in some instances were predicated on China growing 7, 8, 9, 10%, not growing 6, 5, 4, 3, 2, 1, or contracting. So you're seeing a correction in the markets. Our bottom fishers came in late in the day today. The U.S. equity markets were down in the morning. A lot of that, we think, was European investors selling, as evidenced by the fact that after 11:30, when their trading day ended, stocks drifted higher and finished essentially flat. Why were they selling in the U.S.? Probably to cover margin calls in Europe, because the European markets were down, especially the German DAX. Remember, Germany is the biggest export-driven economy. It's the biggest economy, but it's very much an export-driven economy as opposed to the periphery, which is mostly internal demand-driven. So if you thought interest rates would stay low before, they're probably going to stay low even more so now, either longer and or lower than before. Our base case forecast for the end of year 10-year was 2.40, 2.4%. We might get there, but if we're wrong, it's, as we said before, it's probably to the downside, 2.30, 2.20. It's possible. It's not inconceivable that we go to 2 or even below 2 again. Where's inflation coming from? We don't see it. You can't say, oh, you're printing money, you get inflation. No. If you're printing money, but the other guy's printing more money, your currency goes up in value, right? If your consumers aren't spending it, right, and not getting wage increases to spend, it doesn't really make its way into demand. So that's our base case scenario, is that we see low inflation for a longer period of time on the long end of the curve. So this much touted buy tips in bullish inflation strategy is probably going to continue to fall on its face. Those who bought floating rate instruments expecting a rise in rates, right? That's probably not going to pan out. But you should be thankful, because a rise in rates, especially in the junk market, probably would have resulted in defaults by the CCC, maybe even some low single B issuers, even on loans, by the way. Now, this is not to say the Fed won't raise rates at all. We still, at Bond Squad, think that the Fed is going to raise the Fed funds rate by 25 basis points or to 25 basis points. So depending on what government repos it does, what it does with reserve requirements and rates paid on reserves held at the Fed, we should get a Fed funds rate somewhere between a quarter and we think 35 basis points. Unlikely to go up to the top end of that range, which might have been a half. It might go to a quarter to a half range. Probably think quarter to 35, somewhere around that. And that's probably it for the year. If they go in December as well, maybe you get to 50 basis points. We're of the opinion they're not going at every meeting, and they're not going to have a reason to go at every meeting. And at the end of 16, we might be sitting with a Fed funds rate no higher than 1%. All right. Meanwhile, the long end moves with inflation expectations. Sorry, folks, if the dollar's strengthening, right, and we don't have demand-driven inflation, too much money chasing too few goods, services, and opportunities, we're probably not going to see inflation. So that means you're going to get a flattening yield curve at low rates. All right. We've been saying this ad nauseum for 2 years. And still the investment committee guys at the wirehouses continue to say, nope, look what happened before. Again, before we had ZIRP for 6.5 years. When was the last time we had QE? Never mind 3 rounds of outright purchases of long-dated securities. When was the last time we had a technology revolution that was so efficient that it not only augments workers, it can replace them outright? When was the last time we had a baby boom that hit retirement age? When was the last time we had globalization where I could be broadcasting this from Nigeria if I wanted to, or from the Ulaanbaatar in East Asia? It doesn't matter, right? So, and I'm in Jonas, Pennsylvania, in the Bomb Squad Lodge here, but it doesn't matter anymore. This is a whole brave new world, and it could be a whole brave new world for interest rates. So we're maintaining our low interest rates for longer, and we don't mind taking some duration. We don't extend it to the 30-year, but again, the 10 to even 20-year area on the long end of our portfolio seems valid at this point. All right. So what are the markets not getting? Well, the markets are getting everything right. It's the strategists out there. Strategists and fixed income strategists, we're hearing reports on the street that fixed income strategists after fixed income strategists are either being marginalized, laid off, assigned new duties, and the wirehouses are focusing on UMA/track/model portfolio strategists to make calls in the fixed income market. Good luck. Ask your plumber to pull a tooth. All right, it's the same thing. Good at what he does, should be doing dental work. These GIC type guys, Global Investment Committee guys, good at understanding what happened before, bad at understanding why and what's different now. Our experience, but check out the results. So we see this as a persistent problem. So what are investors to do? Well, in our opinion, investors should move up in quality a bit. Don't be afraid of duration to a point. We'd rather take a little duration risk in this environment versus credit risk. The GIT guys, again, take credit risk over duration risk. Things will get better. When the Fed tightens, it means the economy is getting better. And there lies the problem. This has been drained. They brainwashed themselves, and they're trying to drill it into the heads of advisors and investors that the Fed will not be raising rates unless it sees the economy taking off. This is not the case at this time. The Fed is raising is considering raising the Fed funds rate marginally because it doesn't need emergency levels of accommodation. It still needs pretty significant levels of accommodation. Look, a 1% or 2% Fed funds rate is still considered pretty accommodative. We're not talking about going to 2%, probably sometime in 2017, okay, or late 2016, maybe, okay. So the Fed is just going to come off emergency levels. It does not mean that the economy is all hunky-dory. It's not. And we're going to have headwinds coming in from overseas, and we're going to have deflation coming in from overseas, and that's going to limit the scope of the Fed's tightening. Do not believe that this means the economy shifted into a higher gear. It's kind of stuck in the gear it's in. Maybe this is the highest gear it can get to at this point. All right, so we think we see 2% growth. We'll probably see job growth slow into the low 200,000 like we've seen, into the high 100,000s. We think we're getting near the end of this economic cycle, okay? I mean, all signs point to it. So now you're going to start to see bubbles, and we hate to use that word. So you're going to see blisters, little little inflated areas of the market start to pop. We think you see it in the junk market, especially triple C's. You're starting to see it in biotech. That area of the market's been overinflated. You know, it's funny, they ridiculed Ms. Yellen last year when she identified it and say, well, she was way too early on that. No, was she too early, or were the markets and investors and advisors and money managers too late to realize it or admit it? Okay? Don't blame the person who sees it ahead of time. Blame the person who doesn't react soon enough. So we were kind of negative on that sector, negative on small caps. We were trying to move stuff up. Energy, the $100 oil now, in retrospect, looks like it was way overpriced when you consider the slowing in demand, or the slowing in demand increases, we should say, and the glut of supply out there, and the need to keep the supply on the market. Because for some economies, it's better to get something for oil than nothing, than to not sell it, right? Everybody says, "Oh, the Saudis should cut production," and the U.S. production increases, and then the Saudis are selling less at the same low price. They got to keep pumping. It's better to get $40 a barrel than it is to not sell any oil, especially when that's your only income. So we don't think we're seeing a new spike in energy prices or materials prices. We think that they were priced to China building a new city every year. You know, we're exaggerating a bit, but that's not going to happen in all likelihood. Okay? So we don't think we see a benefit to those sectors from higher prices. However, we could see a rebound among the better capitalized, less leveraged oil and materials producers as they become more efficient. More efficient, you ask? How's that possible? Well, remember last year when it was thought that the shale producers couldn't make money below $80 a barrel. They did. So it was $60 a barrel. They can't make money below $60 a barrel. But they did. Now some of them can make money below $40 a barrel, well into the 30s. They've gotten more efficient. They've paired workforce. They've lowered the compensation. They've added better equipment. They become more efficient. You don't think that iron ore producers, copper producers, aluminum producers can't do the same thing? You don't think that agriculture can do the same thing? In fact, agriculture has. We saw grain prices plummet today because grain production, crop output went up. And considering that the U.S. has far fewer farm acres than it had 100 years ago, yet we make several times the amount, produce several times the amount of food from them, it's just getting more and more efficient. This is where we believe the economy is going. Some people think, oh, when all these boomers retire, they'll need services, they'll need caretakers, and there's not going to be enough people to serve them. So workers will be able to will set their own salary, call the shots. We don't think so. We think that technology will be there. So one caregiver could do the work of 2 or 3 in the past. We think that's what happens. And there'll be less money going into discretionary and aspirational goods and services. So that's gonna kind of compress growth a bit too. This isn't bad. This is just different. We have to understand and accept the fact that demographics, technology, and globalization have all changed how economies function. And the foreign central bankers understand this as well, which is why they're trying to stimulate the economy by lowering rates, because no one wants to go back to their constituency and say, you know what, you're going to have to work a 40-hour week. You're not going to get annual cost of living wage increases. You're going to have to retire at 68, and we're not going to pay for all your health care. Like, what, we're entitled to this. So what they're trying to do is devalue the way out of this and export the way out of this. And it probably won't work because many countries, most of the developed world are in the same boat. Now, as they do this, they start to make themselves as competitive, if not more competitive, with the pioneer markets. They're really underdeveloped countries that were supposed to take the ball and run and keep the emerging world, moving higher. That might not happen here. And an emerging market, both bonds and stocks are getting clocked. They really are. We've been negative on EM for the past year, choosing specific countries: India, South Korea, Poland, Mexico. That's been our our area of focus. We did not like Brazil. Brazil got downgraded to Baa3 by Moody's. It's already triple B minus by S&P, and S&P said junk could be around the corner. Brazil is a mess. Make no mistake. The yield curve is inverted like that. You got your short yields, you got your long yields. I'm sorry, folks. Brazil is in big, big trouble. This is not a cyclical problem. This is structural. Okay. So what we're doing on spikes in the market, de-risk, doesn't mean go to cash, go up in quality, go to large caps, go to dividend payers, not necessarily utilities, which have no or very little growth potential as far as price goes, but the larger industrials. We don't see a problem with the larger, better capitalized, less leveraged oil companies, Exxon, ConocoPhillips, those companies. Some of the better drillers, even if you do your homework, what we do, look for the balance sheet leverage on some of the drillers. They look okay. Maybe a longer term hold. Probably like to take that exposure on the bond side rather than the equity side. Get our coupon. Probably like to do that more. Look at the MLPs, the pipelines. The pipeline companies, it's a toll road. Yeah, the prices have gotten beaten up because in this stupid sleeve world, when some geek strategist comes out and says, all right, reduce your energy exposure, investors and advisors go, all right, let's get rid of our energy exposure. They don't differentiate. Well, let's keep the pipelines. We'll get rid of the drillers. Maybe keep the refiners too, right? Because people are still using fuel. Somebody's got to refine it. So it's such a herd mentality and broken into these rigid sleeves. It's stupid. It's really stupid. So what happens? The MLPs get hit. So bonds issued by the pipeline companies look pretty attractive if you can take the volatility. You have to check your leverage on that, see what they transport, oil versus gas. Gas is probably a little bit more reliable at this point, but both, where they're located. But for the most part, these pipeline companies look to be a good way of adding some yield to your portfolio if you can take the volatility. So that's what we're doing. We don't think that the foreign turmoil, and it is turmoil, is going to push the U.S. economy into recession, but it's going to blunt growth and it's really going to hold down inflation here. So when we're looking at to protect ourselves from inflation, we don't really think we need much protection at this point. But if we do, we're looking at the 5 and 10 year U.S. TIPS. We buy actual TIPS bonds, and what we buy and in what portions. One depends on client suitability, goals, objectives, but also the duration of our portfolio. We try to manage the duration, and we also make an intelligent determination. How much of a hedge do we want? Do we want a large hedge because we think inflation is going to spike? Just a little hedge, just in case we're wrong. Right now, we're underweighting the hedge a bit. It's taking up a very small part of the portfolio, 5%, maybe 10% of it's big, but that's it. We're not putting big hedges on. We're trying to make a big bet on inflation. That's been a bad bet since about 2012, and we think it's going to continue to be a bad bet. However, now that the 10-year break even is below 170 basis point, 1.7%, if you're going to add protection, add it now, because inflation only has to average 166 thereabouts, based on when I did the break-even calculation this afternoon. Okay, you might get that average over the next 5 or 10 years. Okay, when it gets close to 2, I'm not taking that bet. I don't think inflation is going to average 2% over the next 5 to 10 years. Could be wrong. I could always adjust. I'm not buying the cash treasury anyway. I'm not going to loan the government money for 10 years, at 215. I'd rather go lend a AA municipality money for 10 years at 330, and that's before my tax advantage, right? So that's another place I'd go. Munis, taxable and tax-free. Risk to reward basis, better than corporates in our opinion. This is not difficult. Where people get in trouble is going, I'll use a go anywhere manager. He'll avoid every pothole. Yeah, how many go anywhere managers loaded the boat with energy and materials because China was going to grow to the sky? Those strategies are blowing up left and right. Okay, so not saying that we didn't have exposure to, but a go anywhere manager might go into dark places. We believe it's better to know what you want, know your risk tolerance, know what you own, and take your risk accordingly. Okay, I feel like I live in a Ralph Cramden world where everyone's trying to get rich quick. The handy dandy kitchen utensil. Everybody's looking for the handy dandy investment utensil. It does everything. Can it core a apple? Yes, it can core a apple. All right. So we're looking for the alternatives and all these funky strategies to try to outdo everything. Come through the back door. A roundabout way, and we'll break correlations. You know what? Build a diversified portfolio. Buy dividend-paying stocks. When you reinvest the dividend, history has proven that dividends are about 70% of your total return. If you're an income investor, buy your bonds, ladder or barbell your portfolio. If rates go higher, the short maturities come due, you can reinvest them. If rates don't go higher, you have the long investments. They'll be locked in at a higher rate. Look for step ups. If you're buying floaters, get a fat spread. We'd rather fix the float preferreds 300 basis points and up. We want the longest fixed rate we can get right now, the highest fixed rate we can get now, and we're willing to pay a premium to get it. We're not looking to trade this. Okay? We're not looking to trade this. We're looking to invest it. We build income-oriented portfolios for the most part. We're looking to find value and flexibility. We don't want to just look for the advantage. We want to be protected on the downside. We look at both sides of the equation. Professionals tend to manage for risk. Amateurs tend to focus on just return. You have to ask yourself: are you an amateur or professional? If you want to be a professional, or you want to invest like a professional, act like a professional. Keep risk in mind at all times. I think that's all we have. I'm checking my list. Notice I can keep my list on an electronic device. More how the world has changed. Let's go back to our original list here. And we did currency race. How bad is China? Which is probably pretty bad. Fed to raise rates in a slow growth environment. We did that. Tips we covered. U.S. dollar strengthening is just in the early stages. We've been long the dollar. We've favored the dollar. When we built international ETF models, we favored the dollar. We put a big weighting, 20-25% in some cases in a bullish U.S. dollar play. Maybe reduce that a little bit now, 10-15%, because when we say the early stage of dollar bull, it's not that the dollar's going to get that much stronger, but it's going to be strong for a long period of time. Maybe 15%. It depends on the client and their goals, objectives, risk tolerance. And with that, we've taken enough of your time, just about a half hour here. Please, if you have any questions, you can call us at, and we can see that, 570-424-1555. Email me, thomas.byrne@wsnm.com. And check out the website, www.bond-squad.com. We have subscription information, details about our portfolio management service. We updated our charts for subscribers. If you have a login, we have the current yield curves, credit curves. Please take a look at it. We've been here all day about cutbacks in strategy, fixed income strategy at the major firms, especially on the retail side. We feel that advisors might be left out left out on a ledge a bit here, and they might not realize what they're missing. They might not realize that their fixed income strategy is not coming from a true fixed income strategist. So please give us a call. If you'd like a trial subscription, a trial run of Bond Squad, let us know. Call us, email us, and we're happy to set you up for a 2-week free trial. We don't think you'd be sorry. And remember, it doesn't just include the newsletter. We are a bond desk that works for our clients. We're not trying to sell anybody anything. We're just trying to sell ourselves. All right. We have the best interest in our clients at heart. $2.99 a year gets you unlimited access to bond professionals and all newsletters and reports. Unlimited. It beats paying annual fees in some ways if you're going to do stuff yourself, or if you're an advisor who wants to know the bond market from bond people, wants to know what the bond market feels about interest rates, about inflation. You want a good outlook on the international economy, Bond Squad is the place for you. And with that, have a great night. Stay well, root for the Mets and Yankees. I told you I'm from a split household. We want to see a Subway Series. And if not, well, hope your team joins us to get beat in the playoffs. Thanks. Have a great night.